When people talk about whole life insurance, the conversation is usually filled with strong opinions. Some say it's a powerful financial tool, while others call it an expensive mistake. But instead of relying on theory or secondhand opinions, I decided to experience it myself. For 5 full years, I committed to a whole life insurance policy and closely tracked how it performed, how it felt, and whether it truly delivered on its promises. What I discovered was not just about numbers. It was about expectations, trade-offs, and how financial products behave over time. This is my honest, detailed breakdown of what really happens when you stick with whole life insurance for 5 years. Today, we will talk about I tried whole life insurance for 5 years. Here's what happened. So, before we start, make sure to hit the like button and subscribe to my channel. When I first started, I was drawn to the idea of combining life insurance with a form of savings. Whole life insurance was presented as a set-it-and-forget-it solution, one that would provide lifelong coverage while also building cash value over time. The idea of having guaranteed growth, a fixed premium, and a death benefit sounded appealing. It felt like a safe, structured way to build financial stability without having to constantly manage investments. However, I quickly learned that whole life insurance is not a simple product. In the early months and even years, a significant portion of my premium was not going toward cash value at all. Instead, it was going toward administrative costs, commissions, and the cost of insurance itself. This meant that my cash value grew very slowly at first. In fact, for the first couple of years, the growth was much lower than I initially expected. One of the biggest surprises during the first 5 years was how long it takes for the policy to catch up. Unlike investments like stocks or index funds, where your money is immediately working and growing based on market performance, whole life insurance operates on a slower, more gradual growth model. It's designed to build stability over time, not rapid returns. This is something that many people don't fully appreciate when they first buy a policy. As I continued paying premiums, I started to see steady, predictable growth in my cash value. The growth wasn't dramatic, but it was consistent. Year after year, the value increased at a fixed rate, sometimes supplemented by dividends depending on the insurance company's performance. This predictability was actually comforting in a way. There were no market crashes, no sudden losses, and no volatility to worry about. However, that stability came at a cost. When I compared the growth of my policy to what I could have earned by investing the same amount of money in the stock market, the difference became very clear. Even with conservative estimates, the potential returns from investing were significantly higher. This is where the concept of opportunity cost became very real. Every dollar I put into my policy was a dollar that wasn't being invested elsewhere. Another important factor I experienced was liquidity. Whole life insurance is not designed for quick access to funds. While I technically had access to my cash value, withdrawing or borrowing from it came with certain considerations. Policy loans, for example, accrue interest and can reduce the death benefit if not managed properly. This made me more cautious about using the cash value, which limited its usefulness as a flexible financial resource. Over the 5-year period, I also realized how important it is to understand the long-term nature of whole life insurance. This is not a short-term strategy. In fact, the real benefits of whole life insurance are often designed to be realized over decades, not just a few years. 5 years gave me a clearer picture, but it didn't represent the full potential of the policy. This is where many people make a mistake. They judge whole life insurance too early without understanding its long-term structure. Another key observation was how the policy influenced my financial behavior. The fixed premiums forced me to be consistent with my payments, which helped build discipline. In a way, it acted as a forced savings mechanism. However, I also felt that this structure limited my flexibility. If I wanted to redirect more money toward other investments or opportunities, it wasn't as easy to adjust as I would have liked. During these 5 years, I also learned a lot about how whole life insurance is marketed. Many agents emphasize the benefits, guaranteed growth, tax advantages, and lifelong coverage. While these are all true, they often don't fully highlight the drawbacks such as lower returns, high fees, and limited flexibility. This gap between marketing and reality is something I became much more aware of over time. Taxes were another area where whole life insurance showed some advantages. The cash value grows on a tax-deferred basis, and policy loans can be accessed without triggering immediate taxes under certain conditions. Additionally, the death benefit is typically paid out tax-free. These features can be valuable, especially for estate planning or wealth transfer. However, for someone primarily focused on growing wealth, these tax advantages did not outweigh the lower overall returns. Emotionally, the experience was mixed. On one hand, I appreciated the stability and predictability of the policy. On the other hand, I often found myself thinking about the potential growth I was missing by not investing more aggressively. This internal conflict is something many people experience when comparing whole life insurance to other investment options. By the end of the 5 years, I had a much clearer understanding of where whole life insurance fits in a financial plan. It is not designed to compete with investments like stocks or index funds. Instead, it serves a different purpose, providing protection, stability, and a structured financial foundation. For individuals who value guarantees and long-term certainty, it can be a useful tool. But for those focused on maximizing growth, it may not be the most efficient option. One of the biggest takeaways from this experience was the importance of aligning financial products with personal goals. Whole life insurance is not inherently good or bad. It's about whether it fits your strategy. If your goal is to build wealth as quickly as possible, there are likely more effective ways to allocate your money. If your goal is to create a stable, predictable financial structure with built-in protection, whole life insurance can play a role. After 5 years, I came to the conclusion that whole life insurance is best viewed as a long-term financial tool rather than a wealth-building shortcut. It has its place, but it should be used with a clear understanding of its limitations. The experience taught me the importance of reading the fine print, asking questions, and understanding exactly how a financial product works before committing to it. My 5-year journey with whole life insurance provided valuable insights into how it operates, what it delivers, and where it falls short. While it offers stability, guarantees, and certain tax advantages, it does not match the growth potential of traditional investments like stocks. For me, the biggest lesson was that no single financial product is perfect. Success comes from understanding your options, staying disciplined, and making decisions that align with your long-term goals. This shift in mindset is important because it highlights a key truth. Whole life insurance works best when you stop expecting it to behave like a high-growth asset. Once I adjusted my expectations, I was able to appreciate what it actually offers: consistency, predictability, and a level of security that's hard to find in more volatile investments. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.